Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into LENSAR, Inc., trading under the ticker LNSR. Following the regulatory collapse of its $14 cash buyout by Alcon, LENSAR is executing an independent commercial resurgence, pivoting from an episodic capital equipment seller into a high-margin recurring razor and blade medtech engine. However, this growth trajectory faces structural market friction, including a multi-quarter international distributor rebuild and substantial convertible preferred share overhang.
Yeah, and it is just your classic Wall Street abandonment story, but with a really fascinating twist. Because usually the market just leaves a company for dead after a failed buyout.
Right, totally. The premium vanishes, the arbitrageurs flee, the stock just tanks.
Exactly. But if we look closely at LENSAR's second quarter 2026 data, we see a company that actually used its time in this merger limbo to quietly build a highly profitable independent foundation.
Which is why I want to welcome you to this deep dive, because our mission today is to figure out if this broken merger has, secretly created one of the most asymmetric turnaround opportunities in the entire medtech space right now.
It's a huge question.
I mean, we are looking at a stock that plummeted from nearly $13 down to under $5, just simply because the FTC blocked their acquisition. I mean, imagine you're standing at the altar, right? The wedding gets called off at the absolute last minute, but the venue is like, hey, you get to keep the $10 million non-refundable deposit.
That altar analogy is perfectly accurate for their balance sheet reality post-termination.
Basically getting paid to walk away and keeping the ring.
Yeah, pretty much.
Yeah.
When the FTC stepped in on March 16th, 2026, and they basically said combining Alcon's market-leading system with LENSAR would create an illegal monopoly, the deal just died.
Right.
But the termination agreement allowed LENSAR to retain a massive $10 million cash breakup deposit from Alcon. Yeah, they recorded that as acquisition-related income in the first half of 2026. So their former suitor essentially capitalized their independent strategy.
Okay, let's unpack this, because it wasn't just a one-time cash infusion from that breakup fee, right? There has to be a massive cost relief element here, too.
Oh, absolutely.
Because while that merger was pending, LENSAR must have been just hemorrhaging money on transaction fees, legal teams, M&A advisors, all that stuff.
They absolutely were. They absorbed nearly $13 million in cumulative deal-related advisory and legal expenses over the whole pendency of the deal.
$13 million.
Yeah. If you look at just the second quarter of 2025 alone, those fees were a $4.2 million drag on their financials.
Jeez.
Fast forward to Q2 2026, and that expense is completely eliminated, so their total operating expenses for the quarter dropped down to a much leaner $7.6 million.
So by stripping away the merger costs, we're left with a balance sheet that looks, frankly, bulletproof for a small-cap medtech.
It really does.
Because they exited the second quarter with $13.6 million in cash, absolutely zero funded bank debt, and they operated essentially a cash flow break-even, right?
Right, exactly. And to top it off, they actually went out and secured a new $10 million credit facility with Salem 5 Cent Savings Bank.
Which is an asset-based credit facility, or an ABL maturing in August 2028.
Yes, a brand new ABL. And it's secured by their accounts and lease receivables. It basically completely replaces an old, unutilized margin line they had sitting with Wells Fargo.
And having a dedicated working capital revolver like that gives them, serious runway, which means they don't have to go back to the public markets to raise money.
And that is the crucial takeaway for you listening. LENSAR didn't just survive the FTC blocking the deal. They emerged fully funded to execute their standalone commercial strategy.
Right, without diluting current shareholders.
Exactly. They have explicitly stated they have sufficient liquidity for at least 12 months without needing to resort to dilutive public equity offerings. And that removes a massive layer of existential risk that usually just haunts these microcap turnarounds.
Yeah. But a strong balance sheet just buys you time to figure things out, It doesn't automatically generate returns. So we have to look at how LENSAR is actually making money now that they're out on their own.
Right, the actual business model.
And this brings us to their pivot from just selling big, expensive medical machines to building this recurring medtech engine. I mean, it's the classic razor and blade model, but scaled up to an incredible degree.
Sell the handle cheap and make the compounding margin on the disposable blades.
Yeah, but I marvel at the scale here, though. In this scenario, the razor is literally a compact robotic dual-pulse femtosecond laser system called the LIY.
Which is a very expensive handle.
Right. And just so we don't get bogged down in medical jargon, a femtosecond laser is essentially a tool that uses ultra-fast, incredibly precise pulses of light to make incisions, basically replacing a physical steel scalpel in eye surgery.
Exactly.
And the blades for this system are digital procedure licenses and disposable patient interface device kits, PIDs, that the surgeon is actually required to purchase for every single surgery.
It is a phenomenal commercial architecture. I mean, let's deconstruct the second quarter financial inflection because it proves the model is working.
Let's do it.
Total revenue expanded 18% year over year at $16.5 million. But the core driver underneath that top-line number was a 23% surge in procedure revenue, hitting $10.2 million for the quarter.
Okay, so the surgeons aren't just letting these expensive lasers sit in the corner of the room. They are actively utilizing them at a higher rate.
Precisely. And when you combine the digital procedure licenses, the disposable PID kits, the equipment leases, and the extended service contracts, their recurring revenue reached $13.7 million in Q2.
Wow, so what percentage of sales is that?
That represents a massive 83% of their total sales. They have effectively established a $55 million annual run rate built almost entirely on high-margin, predictable, recurring streams.
That's huge. We have to audit those margins, though,
Right.
because, forensic accounting is really important here. I saw they reported a GAAP gross margin of 59.3%.
Which sounds incredible.
Yeah, it sounds incredible for a company selling hardware alongside software, but there's a distortion in there we need to clear up.
Yeah. What's fascinating here is how a macro legal event temporarily skewed their unit economics.
Oh, the tariff thing.
Right. We have to isolate a one-time $1.1 million tariff refund. Basically, the U.S. Supreme Court invalidated certain tariffs under the International Emergency Economic Powers Act, or IEPA.
Okay.
And LENSAR benefited from this ruling, so they recorded the refund as a reduction to their cost of goods sold in Q2.
Got it. So if I'm doing the math, getting a sudden $1 million refund on your component costs artificially inflates the gross margin for that specific quarter.
It does.
It makes the underlying business look slightly more profitable than it actually is on a day-to-day basis.
It does, but here is the critical forensic detail. Even when we strictly remove that $1.1 million windfall, the true underlying core gross margin still stood at 52.3%.
Okay, so still very strong.
Very strong.
Yeah.
That is up from 50.4% in Q2 of 2025 and 48% in the first quarter of 2026. Because recurring procedure revenue carries a significantly higher gross profit than selling the heavy hardware, every new machine they place compounds their bottom line profitability.
Right.
That underlying margin expansion is how they achieved a company record adjusted EBITDA of nearly $3.6 million in Q2.
Okay, the financial math definitely makes sense.
Yeah.
But we need to connect that to the clinical reality because surgeons are notoriously stubborn about changing their daily routines.
Yeah.
Especially with delicate procedures like eye surgery.
Well, extremely stubborn.
So why are they adopting this specific system fast enough to drive 23% procedure growth? Is this just better marketing, or is the LIY system actually doing something the incumbent lasers can't?
It is entirely about workflow economics and solving a severe historical bottleneck in the operating room. To really understand the Ally advantage, we have to contrast it with first-generation platforms.
Okay, walk us through the old way.
Traditionally, femtosecond laser-assisted cataract surgery, which is called FLACS, required a really cumbersome multi-room setup.
Multi-room.
Yeah. A surgeon would have to prep the patient in a non-sterile laser room. They would use an older, slower laser to make the initial corneal incisions and break up the cloudy cataract lens.
Why?
Then the nursing staff would have to physically unhook the patient, wheel them down the hallway into a separate sterile operating suite, prep them all over again, and then manually extract the cataract and implant the new artificial lens.
Wait, mid-surgery? That sounds incredibly inefficient. You're talking about doubling the prep time, tying up 2 separate rooms, and needing extra nursing staff just to manage a hallway transfer.
It was a massive friction point. And this spatial bottleneck is exactly why a large segment of the market remained what the industry calls femto-naive.
Femto-naive, meaning they just didn't use lasers at all.
Right. These were surgeons who simply avoided using lasers altogether because the extended cycle times just ruined their daily patient volume. The LAY system changes this completely.
Because it's smaller.
It's a highly compact, AI-guided dual-pulse laser that enables a single-suite sterile workflow. The entire procedure, the precision laser incisions and the manual lens implantation, it all happens in one room without ever moving the patient.
And when you don't have to move the patient, you obviously save a tremendous amount of time. And this is where the private equity angle becomes so crucial.
Yes, definitely.
Because we see private equity roll-ups buying up independent eye clinics all over the country right now.
And these highly leveraged, high-volume PE ophthalmology networks are driven entirely by throughput efficiency.
Let's do the math on that for the listener because it's a massive aha moment. Let's say a surgeon takes 30 minutes for a standard cataract procedure using the old two-room method. If the Ally system cuts out 10 to 15 minutes of room transfer and prep time, that surgeon can suddenly fit in 3 procedures an hour instead of 2.
Exactly.
Multiply that by an 8-hour day across a network of 20 clinics. The private equity firm is instantly generating millions more in revenue simply by changing the hardware.
That throughput math is exactly why LENSAR's winning over these corporate practices. They basically negotiate volume-tiered contracts where LENSAR might subsidize the capital costs of the LI system up front in exchange for ironclad procedure volume commitments with quarterly true-ups. And the data proves it is working. Installed LENSAR units achieved a staggering 31% higher procedure volume compared to MarketScope's stated national average. They drove total Q2 volume to 58,682 procedures.
Wow, 58,000. Which means they're aggressively taking territory. I mean, their U.S. procedure market share expanded to 24.1%.
Yeah, by solving those spatial and time constraints, Ally Y has created a true economic moat for independent ambulatory surgery centers.
Okay, here's where it gets really interesting, though. If the Ally system is this revolutionary and these PE networks are realizing this massive ROI, why aren't they deploying hundreds of these machines immediately?
Well, that's the catch.
Right. We have to look at the operational bottlenecks. There is a massive irony in having a backlog of demand that you can't instantly cash in on. Does this create a deceptive lag in their upcoming quarterly earnings?
It absolutely creates a phasing issue that impatient Wall Street analysts might misinterpret. Look, LENSAR exited Q2 with an installation backlog of 13 Ally robotic systems.
13 units just waiting to be installed.
Right, but you cannot just drop a multi-million-dollar medical robot in the mail, plug it into a wall, and start collecting recurring revenue the next day. We have to unpack the real-world delivery pacing.
Let's start with the domestic friction. Why aren't those U.S. backlog units spinning up faster to generate cash?
In the U.S., several placements are contracted for newly built, state-of-the-art surgical facilities. LENSAR is literally waiting on the customer's own construction timelines.
Oh, so they're waiting on, like, drywall and plumbing.
Exactly. If the concrete isn't poured, they can't install the machine. Furthermore, even once the ALI is bolted to the floor, there is a mandatory 60 to 90-day post-install training ramp before surgeons reach peak procedure volume.
Ah, okay. So a machine physically placed in a clinic in June doesn't actually hit its financial stride and generate max recurring revenue until September or October.
Exactly. And the international friction is different, but equally impactful. Distributor purchase orders are heavily weighted toward fourth-quarter delivery windows.
Why Q4 specifically?
It's tied to regional holiday schedules and hospital fiscal budget cycles, where international clinics wait until the end of the year to spend their allocated capital.
Right. Plus, we have to factor in the channel freeze that happened during the whole Alcon merger saga.
Right. During the merger limbo, international distributors basically paused their marketing efforts.
I mean, that makes sense. Why aggressively sell a LENSAR machine to a hospital in Europe if the company is about to be absorbed by Alcon, who might just discontinue the product line?
Exactly. And now, LENSAR has to rebuild that momentum. Their strategy involves taking direct commercial action at the European Society of Cataract and Refractive Surgeons, or the ESCRS meeting, in late 2026.
Okay.
They're using their recent EU MDR certification, which is the rigorous European medical device standard, to revive those European and Asian distribution networks.
But rebuilding a global sales channel from a standstill takes quarters, not weeks, which means analysts projecting Q3 revenues might be disappointed because the 10 Ally Y placements from Q2 plus the 13 units in the current backlog won't generate their peak recurring licensing fees until the fourth quarter of 2026 or maybe even the first quarter of next year.
The cash is coming, but the structural delay is very real.
Okay, but even if they conquer those operational delays and place every single machine in their backlog, we still have to ask, who actually gets to keep the money?
The cap table.
Yeah, that brings us to the capital structure.
Yeah.
Because if I am listening to this and I look up the LNSR stock ticker right now on my phone, My app probably says there are roughly 12.3 million basic shares outstanding. But you're telling me I would actually be buying into a pool almost twice that size. That is a massive hidden dilution.
It is a critical distinction that everyday investors often miss, yeah. The basic share count is 12.3 million, but their fully diluted count is 23 million shares.
23 million.
Right. When you are trying to figure out what the whole company is worth, you have to divide that value by 23 million, not 12.
So where is this phantom equity coming from? Just break down the financial jargon for the listener here.
Sure. The primary overhang comes from Northrun Capital. They participated in a private placement, and they hold Series A convertible preferred stock.
Okay.
That preferred stock carries a $20 million liquidation preference.
Meaning they get paid back first if the company is sold.
Right, and it converts into 7.94 million common shares.
Wait, and I saw in the filings that this preferred stock also gives Northrun Capital 44.9% of the voting power, along with 2 board seats. So Northrun basically owns the steering wheel here.
They effectively control the company's destiny. And alongside that preferred stock, there are 4.4 million Series A and B warrants with strike prices around $2.45 and $3.06.
Okay.
These warrants introduce a highly complex accounting quirk on their balance sheet known as a Level 3 derivative warrant liability.
Okay, let's translate that, because Level 3 derivative warrant liability is exactly the kind of jargon that glazes eyes over.
It really is.
I visualize it like an insurance policy that LENSAR wrote. If the company gets bought out, like a change in control, these warrant holders are guaranteed a payout that assumes the stock was incredibly volatile and valuable. And because that insurance policy is sitting out there, accounting rules force LENSAR to put a price tag on it every single quarter as if they had to pay it out today.
That is a brilliant way to explain the mechanism, actually, because the payout is guaranteed to reflect a certain level of volatility, regardless of actual market conditions. It acts as a liability. Right now, that liability carries a $15 million value.
So if the stock goes up, the cost of that insurance policy goes up on paper. Doesn't that mean their official GAAP net income is essentially useless for us to look at?
Mm-hmm.
The wild swings in the warrant liability would completely obscure how much cash the actual lasers are generating.
Exactly. You absolutely have to look at adjusted EBITDA to see the core business.
Right.
Now, speaking of a change in control, there is also a contingent payout of $1 million to former vendors if the company gets bought out. Which kind of brings us back to the M&A asymmetry.
The buyout potential.
Yeah. We know the FTC blocked Alcon to prevent a monopoly in FLCS, so a lot of investors assume the government just made LENSAR permanently unacquirable.
I would think the opposite, actually. The FTC blocked Alcon because Alcon already owned the dominant LENSAR system. The issue wasn't the ALIY technology itself. The issue was Alcon trying to own 80% of the market.
If we connect this to the bigger picture, the FTC's block actually defined the exact regulatory boundary.
Right.
It makes LENSAR a perfect, completely de-risked buyout target for competitors who lack a dominant footprint in the laser cataract space.
You mean companies like Bausch Lomb, Carl Zeiss Medtech, or Johnson & Johnson?
Precisely. They have much smaller laser footprints. More importantly, they lack a compact dual-pulse robotic platform capable of single-suite sterile operations. An acquisition by Johnson & Johnson, for example, would not trigger the same antitrust alarms because they aren't currently dominant in this specific niche.
So what does this all mean? We have to synthesize the turnaround, the recurring cash, the operational delays, and the heavy dilution.
To understand the valuation, LENSAR operates as a specialized robotic precision scalpel, carving out high-margin recurring territory within a consolidating global ophthalmic market.
I love that analogy. Let's apply it to the final verdict on valuation here. At current trading levels, if we use that fully diluted share count of 23 million shares, and we adjust for their net cash position, LENSAR trades at an enterprise value of approximately $175 million. Or if you just look at the basic shares, it's roughly $105 million.
Which means when you measure that against their $55 million annual recurring revenue run rate, the company trades at under 3.2 times recurring revenue.
That's incredibly low.
And remember, that revenue is expanding at over 20% year over year, and the core operations are generating positive adjusted EBITDA.
Right.
In the medtech space, finding an FDA-cleared EU MDR-certified robotic platform with a 24% domestic market share trading at that multiple is incredibly rare. It represents a highly asymmetric small-cap turnaround.
But we always define the risk before we look at the reward. What are the primary execution hurdles standing in the way of that upside?
There are 3 immediate risks. First, third quarter seasonality. The summer months mean surgeon vacations. Fewer working surgeons mean fewer cataract procedures, which would soften Q3 recurring revenue.
Makes sense.
Second, near-term operating expense normalization. Interim CFO Michael Rossi was very clear that SG&A expenses will trend modestly higher in the second half of the year as they aggressively hire more sales headcount to push the LAY system into new territory.
Okay. And the third risk is always the competition.
Yeah.
The incumbent giants aren't just going to let LENSAR steal their market share without a fight. Bausch Lomb is actively developing its SeeLyra second-generation laser platform. And I understand that will feature live OCT guidance.
Yes.
Just to clarify for the listener, OCT stands for optical coherence tomography. It is essentially a live, high-resolution ultrasound, but it uses light instead of sound, allowing the surgeon to see detailed cross-sections inside the eye in real time.
It is advanced imaging, and it shows the industry is catching up. LENSAR has a significant technological lead right now with the ALI system, but they have to capture as much market share as possible before well-funded competition like the SeeLyra platform hits the market.
It is an absolute race to own the operating room. Which leaves us with a broader, provocative thought for you to ponder long after this deep dive ends. Think about the massive trajectory shift of the entire healthcare industry. What happens to the economics of a hospital when the physical, multi-million-dollar medical hardware bolted to the floor of an operating room simply becomes a loss leader? When the real compounding profits for these tech companies are driven entirely by invisible software updates and digital per-click procedure licenses? Risk defined. Portfolio